Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Cachia, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. Welcome back to Cash Talk, and today I'm joined by Anth. Anth, how are you, mate?
Good, thanks. Yourself?
Yeah, not bad, mate, not bad. Harry Sheasel, 54 possessions, mate. You must be bouncing around.
Yeah, he's the best ever. Too good. Yeah, he's just the one record he's broken. He's got many more to come.
Does he bring North Melbourne back to premiership glory in 2026? Or?
Yeah, he's gonna be the future captain of the club. Currently vice captain. He's got a long way to go. Only 20, and he's gonna be dragging that team back to the top where we belong.
You got high hopes. Well, I wanted to get that on record just to see where he ends up. But there's been a bit of banter between me and Anth. The whole Nick Dacos, Harry Sheasel debate, but I don't think it's really a debate, so we better get into it. So, Anth, thanks for jumping on. Today, you kind of taken the reins to Cash Talk here. I heard that I've just got to kind of sit down and listen, because what are we talking about today, mate?
Yeah, it's a bit of my specialty, actually, and it's first home buyers, getting into the property market for first home buyers, a couple of things to know, and a few sort of handy tips for people looking to purchase their first home.
Yeah, it's well, first and foremost, it's a massive decision, and if it's for, you're looking to purchase your first home, and we know that this is happening at later in life. It's not just for the younger cohort. This is, people in their 30s and 40s that are entering the market, things to kind of look out for, but also as well too, preparing your kids as well too for their purchase of their first home as well too. So interesting to kind of get into this topic.
Yeah, so look, when you're buying a home, there's a couple of key things to have a look for. So having a look how much you can borrow, there's two really main components that you need to satisfy. Number one is how much you can borrow based on your income and expenses. Okay, so the bank's going to have a look, what can you afford to repay? They take into consideration your income, taxes paid, your living expenses, any other debts and liabilities. They take that all into consideration. They have a look at how much surplus cash flow you have, and then how much of that you can afford to put towards a home loan. With that, a very important consideration is the banks use assessment rates. Okay, so they're not assessing you on 5.5% interest rates. They're looking at like 7.5%, 8% when they're looking at if you can afford to borrow the money. So
why is that, Anth? Why is there assessment rates in place?
Well, a really good example of this was not too long ago when interest rates were at an all-time low, and then they skyrocketed. If there wasn't any assessment rates, a lot of people would have been in even worse positions than what they currently were, because
so it's a risk mitigation tool from the lender to safety net their security by ensuring that the person who's repaying that can afford it at a higher interest rate.
Correct, because rates are volatile. They can go up and they can go down. And if just because you can actually afford to pay repayments when the rate's at 3%, that's not going to be 3% for the next 30 years. They're going to be up. They might go up to 6-7%. And you need to be able to make those repayments, because if you can't just, sorry bank, can we just put a hold on this, or can we pay a little bit less? It's you either pay or you're going to lose your house.
Yeah, get it. So income is obviously a big factor of that. Spending as well too.
Yeah. So look, there is a minimum level of household expenditure that the bank will apply regardless. So even if you are really good at spending and you're only spending $100 a week on groceries for your family, the bank's
quite frugal. There's still a flaw.
There is a flaw, because they have to say, like, look, things may change. We want to make sure there's a little bit of a buffer in there too. So they call that HEM, which is the minimum expense level which they apply. So income, expenses, but then also the other one is debts. Okay, so home loans, if you've got HEX debts, they take that into consideration. The interesting one with HEX debts, though, is they don't have a look at your total balance. They actually want to see what your monthly what your repayments are going to be based on your income. So obviously, the higher the income, the larger portion of your income that needs to go towards your HEX debt. There are a couple of policies out there where if you have a low amount of HEX that is like under 10 grand, they can actually exclude that. But that's the thing with lending. There's so many different policies with different lenders, which makes it very important to actually see a professional to help you in this space.
And so Anth, when you're talking about things like afterpays and loans like that, they're also...
Yeah, so buy now, pay later debts are also included in there. They'll have a look at the total debt and how much the repayments are and put that in there. But the most interesting one is actually credit cards. And this is the one that probably comes up the most, because people say, yeah, I've got a credit card, but we pay it back every month. It's all good.
Or we've got one and we've never used it.
Yeah, like if that credit card is open, it's on your credit file, the lender is going to use the minimum repayments you need to make on that credit card and add it to your serviceability.
Yeah.
Regardless if you've never used it or there's no money owing on it, they are going to take that minimum balance because the minimum repayment, because at the end of the day, that is just like an open credit facility. Like it's like having a loan.
I can use it. It's there.
Yeah, it's like having a loan. Like, yeah, I've got a loan, but it's fully offset. They're going to still take that full loan into consideration. So it's a very important one where people don't really think that it gets applied, and it can make us a pretty big difference, especially when you're having a look at like credit limits of like 10, 15 grand. It's pretty significant of how much reduction in borrowing it has.
Yeah, especially on things like car loans and stuff like that. They really chew up serviceability as well too. And the other factor that which at least leads on is to another one where you got income, expenditure, debts is credit. Now, two things where I want to explore a little bit. Number one is around like, what are all of these afterpays and stuff doing to your credit? And then the second part of the question is around, I sometimes get asked, I'm just going to get a credit card so that I have a credit score. So let's start with the first one first. Like, how much is all of this debt affecting people and how is it affected? And then second one around not having credit and then getting credit.
So when you have a look at your credit file, there's a few things that impact that. One of the biggest one is your ability to make repayments and actually meeting your repayments every month. If you miss repayments, that is a big red flag on your credit file.
And unpaid debts is even more.
Yeah. So making sure that you're making payments towards your debts every payment when every payment is due, that's a big one, because once you miss a payment, you start to half the amount of lenders that are going to take you into consideration.
And let's say I've like, I've forgotten, it's happened to me, yeah. I've forgotten to just put money in that account or whatever's going to be the case, or payments of, like, if something happens like that, that's really out of the blue, does that hinder the application?
Look, there are the banks do understand there are sometimes mistakes that happen, and if you can have the proof to say, look, I had the money there, it was in the wrong account, it got transferred the next day and it was paid. If you can show those it was
a one-off out of 12 months. I've done one of them and it was paid within 2 days or whatever. Yeah,
and they can see that the money's there. If you've got evidence of that, it's sometimes they can understand and we can get around that, but. Once, yes, okay, but once you start doing it multiple times, then it's a habit.
It's the patterns. Okay, cool. So these accessing credit, for example, like afterpays, personal loans, credit cards, every time you're applying takes a hit on your credit card.
So that's what happens. So every time you apply for these things, they come up on your credit file, and the more times you apply, it's the more that it affects your credit score. So like if you're doing it once a while, it's not an issue. But if you're doing it like 5 times a year, then it's going to start hindering on your credit score, which you want to try and avoid.
Yeah, because they're saying like, why is this person trying to always apply for credit? If they've got enough cash flow and they've got enough assets behind, they shouldn't be needing to apply for credit this much. Cool. Which brings me on to my next one. Is around, you know what, I got a credit card because I want to get a home loan and I want a credit file. And that's a bit of a myth, isn't it?
Yeah, it doesn't make a difference. If you've got a credit card, it's not like it's going to boost your credit score or it's going to make a big significant difference. At the end of the day, all that's doing is it's probably more of a burden because you're more likely going to need to just cancel that credit card when you're going to apply for the home loan. And it's going to say, all right, like, how many times have you applied? If it was just one credit card you've applied for once, it's not going to really make a difference.
So if they're an absolute beginner to credit, so they've never got debt before, they've got good income, good expenditure, no credit score, you're not turning them away, are you?
No, there's no, like, I would never say to someone for the sole reason of, let's get a credit file and get some score happening, go open up a credit card. You don't need to be doing that.
Sounds good. So, and there's also a lot of concessions and stuff like that for first home buyers as well too, which I want to explore. Probably the other one that I want to just go through is because we've gone through income, expenditure, debts, and we've gone through credit, is also around like deposits as well too, because it forms into these concessions as well. So one of the biggest things we know is entering in the property market is the deposit. And we're seeing a lot more people that are getting the bank of mum and dad to step in. So maybe just explore, the options that are available and what some, rule of thumbs.
Yeah, so obviously, like I said, the first biggest thing is what they look at is your serviceability, how much you can borrow based on income and expenses. But number two is how much you can borrow based on your deposit. Okay, so when you have a look to borrow money, the bank there's something called an LVR, which is a loan to value ratio. And that is essentially how much debt you've got in comparison to the security value. Okay, the property you buy is a security for that loan because you're borrowing that money backed by that property. So having a look at it, if you've got a $1 million property and you've got an $800,000 loan, you have an 80% LVR. Okay, if you have a $1 million property and you've got a $500,000 loan, you've got a 50% LVR. So for first home buyers, they do have a bit of help with the LVR situation and having a lower deposit to get into the market. The standard rule for a standard transaction to avoid any extra fees and costs and being penalised on a rate is to have a 20% deposit. The bank's golden number is an 80% LVR.
And so that includes, Anthony, just so we are all aware, let's say you have $1 million property that you're purchasing and you'll have an $800,000 home loan. Therefore, you've got $200,000 as a deposit plus your stamp duty and legal fees.
Yeah, so general rule is if you wanted to know what the target number is to make the ideal purchase situation, it is to have 20% deposit plus stamp duty plus cost. Okay. By doing that, you don't have to have a look at lender's mortgage insurance, known as LMI, which is a premium that you have to pay to the bank essentially for taking on more risk because they have a lower value of security in comparison to the loan. So they want some extra backing, and for that you need to pay LMI.
And also, when you talked about if you go above that the rate slightly changes, because they're taking on more risk, they're essentially saying, hey, you've given me less of security, therefore I'm going to charge you more for that transaction, which is interesting. If you have a low LVR, so let's say you've got like a 50% loan to value ratio, so you've got $1 million property and only borrowing $500,000, does that drop my rate?
Yes. So in terms of LVR, once you're under 60% LVR, that's usually when you're getting the best rate. Okay. Generally, if you go 40%, sometimes a little bit better, but usually 60% is once you're under there, you're getting onto the
and with significant still loan, as in I would say that you got to still have a loan outstanding of say above 250. Yeah. Anything less than 250, it's kind of the lender's just like it's not really worth their exercise. So above 250. And then loan to value ratios of say 50, 60, even 70%, you start to get some really good rates.
So for the best rates, you need to be under 60%. Between 60 and 70, you do get a bit of a better rate. And then from 70 to 80, that's where like the standard rate lies. But then on the other side, going from 80 to 90, that's when you're getting a bit of a high rate.
And even a difference between 80 to 85, isn't it? Each percentage more, the rate changes.
Like some lenders even do 95%, but you are paying a very high rate for that. And I try to get people to avoid that as much as you can. Unless you've got you've got a new job and you've got some really good income now and you're really in a rush to get into a property, then I would try and avoid that situation.
So, I'm buying $1 million property. Let's play this out. I've got $100,000. Okay, so I've got 10% deposit, and I'm a first home buyer. It's me and my wife. We're looking to purchase. Income stacks up, everything like that, but we're pretty low on a deposit. What's some of the options that we have available?
Yeah, so for when you're buying for about $1 million, you are missing out on most of the first home buyer concessions that you're able to get. So in that scenario, when you're looking at $1 million, the only real with a 90% LVR, the only real incentive that you're going to be able to get to help you out is trying to look at a family guarantor. Okay, so there are certain lenders that have really good policies about family guarantors where you can borrow the 20% deposit, stamp duty and cost against a family member's house, and you borrow the other 80% against your own home that you're purchasing.
So in this scenario, what would effectively happen is they would take that other property as security as well as mine, look to see if there's equity in that property, and then if along as my income and my income and expenditure and all the stuff we went through previously stacks up, they'll allow me to borrow 80% on my property and then the missing, say, 10% that I didn't have from that deposit, because remember, I'm putting the 100 grand down, I'll be able to kind of service on that other property. Now, we're seeing this happen more and more, in regards to this being available. Another one that's being done is in regards to just gifting. So parents will say, hey, listen, you put in 100, I'll put in the other 100, and we'll kind of just gift that. There is things that we talk about with clients at that point. When you give someone money, especially if it's, let's say you're giving it to your daughter and they're with their boyfriend, or essentially you're giving it in most cases to both of them. So we need to make sure that we've got some protective measures in place to protect that money if that's what you want. But the lender will see that differently if it's actually formalized in a loan. So if the money is given in a loan, well, then they're going to use that as hey, you've got an outstanding debt with someone else, don't you, Anthony?
Yeah. But that is if you're looking to buy for $1 million property, okay? Let's say you're a first home buyer and you're looking to buy something a little bit less. There are some concessions that are actually really helpful to get first home buyers in the market.
And these concessions do change state by state, And so it's very, very important when we're talking about these concessions that majority of the concessions we're talking about right now are in Victoria, but there's also ones around different states. But please make sure you speak to your legal advisor or conveyancer. We're making these transactions to understand your particular concessions that are available for you, especially when it comes to stamp duty and grants.
Yeah, 100%. So, look, I think the first one that's a bit of a help with buying your first property is the stamp duty concession. Okay, so in Victoria, you buy a property for less than $750,000, you get a concession on the stamp duty that you need to pay.
And when you say concession, is that a full concession at $750,000?
No, so you just get under $600,000, you pay no stamp duty. From $600,000 to $750,000, you get a discount on stamp duty, and that's sort of scaled. The closer to $600,000, the bigger the discount. As you get to $750,000, you pretty much get a very minimal discount. But that is going to be a big help when you take into consideration some of the other incentives that they have.
And all states pretty much have something similar in regards to a concessional for those type of properties. But you can look onto these the government websites that are in association with your state to also get some good understanding about this stuff as well.
Yeah, and I think New South Wales is about $800,000, up to $800,000 you get a concession, and Queensland is up to $700,000. But one of the ones that I use a lot, which is really, really good, is the first home buyer guarantee. So what the first home buyer guarantee does, it allows you to have a 5% deposit and not have to pay any LMI. Okay. So there are a few rules involved with being able to do this. Number one is it's based on your income. Your income needs to be under a certain bracket to be able to qualify for this. So as singles, you need to have incomes of less than $125,000, and as a couple, it needs to be less than $200,000.
And is this at a national level, Anthony?
Yes. Yeah. So it's at a national level. And they base this income based on your notice of assessment from the last financial year. So
okay, so it's actually your taxable income.
Yeah, your taxable income. So moving into the 2026 financial year now, they will need your 2025 notice of assessment. So, especially if you're buying at the start of the year, you need to rush a little bit to get your tax returns done for that notice of assessment. But there are also spots available for this. So it's not unlimited. I think it was capped at 35,000 spots. And then the other thing that they have a look at is the property value. So there is property value caps on each state. Okay, if you're buying regional or metro, it differs as well.
How does it happen? How does it work, Eth? We just talked about LVR with only having a 5% deposit with this government guarantee. Does it affect the rates?
Yeah, so you do pay a little bit more of a high rate, but you're not paying the rate that you would stay on a standard 90% lend. You're not going to be penalised with those high rates. You pay slightly higher than, say, an 80% LVR, but because the government is actually backing the other 15%, there is less risk for the lender, so they can afford to give you a better discount on the rate. So with that, in New South Wales, the maximum price on the first home buyer guarantee purchase price is $900,000, Victoria is $800,000, Queensland is $700,000, and then Western Australia, South Australia, and Tasmania is $600,000. So if you wanted to put it this way, the most affordable way to buy a house in Victoria, let's say if you find something for $600,000 as a first home buyer, no stamp duty. Okay. Secondly, using the first home buyer guarantee scheme, you could then use a 5% deposit. So 5% of $600,000, you're looking at a $30,000 deposit to get into your first home. So that's probably like the minimum amount you would need to be able to look into something. And then there is also other grants too, like there's a first home owner grant. Okay, so I know these words are all very very confusing. There's a lot of FH and O's and G's, but so first home buyer grant is the 5% deposit. And then first home owner grant is if you are the first owner of a property, the first one to live in there, you can also get a $10,000 grant essentially from the government.
So that's obviously for new homes only?
Yeah, new homes. So if you're building a home, you would get that. Or if you purchased a home, let's say a builder just built some homes and they're selling them, you're the first one to buy it and first one to live in it, then you're also eligible for that as well. So that's another handy one. There are other ones which I probably won't get into too much, but first home super saver scheme is also another one that can help.
Yeah, and that's a contribution strategy that you can apply in your superannuation to get access to funds in your superannuation and get a tax saving on the way through. It's good to explore it. It's probably a topic in itself, in regards to getting it right, the timing and all of that stuff. And there was another thing that I wanted to speak about that I have a lot of conversations with first home buyers is around the type of house. You know, it's around like there's this constant conversation around like, do I just get any house, get my foot in the door? Like, we can't tell you which house to buy. However, from a philosophy perspective, and what's your thoughts on this?
I think it really depends on the individual because it depends on, okay, where do you live currently? Where is work? Where is family? Okay, that's usually the biggest factor in when you're buying a home. Where do you work and where do your family live? Okay, you want to try stay relatively close. But then the closer in you get, the more expensive that goes. It then comes to, okay, how much of a deposit do I have available to me? What can I afford to buy? And then with that, how are our income stacking up? Do we save on a regular basis consistently now before we have the house? And we will be able to make repayments on this house when we purchase it. So it's really setting that budget to know how much we can afford to pay on repayments and then working backwards.
Yeah. And I think you hit the nail on the head around affordability. Like, get what you can afford. And it's not just the affordability now. We were working with a couple, I think they're 25. They've just bought their first home and they're renovating it. And I mapped out the next kind of 10, 15 years from them. And I'm so glad I did. They were walking off a cliff financially. And it was eye-opening for them. But I told them, this hasn't been done yet. This is what we need to do. This is what we need to work on. This is where we need your incomes to be, to get you to this point. And so, if they bought, I think they bought maybe a house worth, say, $750. Yeah. If they were, let's say they bought a house for, say, $250 more, horrible.
Yeah, and that's why it's so important that you actually have to, like, an exercise I like to run is, all right, how much are you looking to buy for? Okay, and then we'll figure out what's the loan going to be. These are the repayments for the loan. Add a little bit of a buffer. I want you for the next 6 months to be able to save this because this is the loan repayment. This is what you would be. This is what you're going to be paying. And once you commit to it, there's no getting out of it unless you sell the property. So making sure you can live comfortably, do everything you need to do, be able to save and afford to pay that debt. But as well, the cost in owning a property. You've got rates. If you've got
water, that.
Yeah, you've got rates, water, electricity, your internet, your home and contents insurance. There are some ongoing costs as well. So you need to factor that in too, especially if you're going from living with family to into your own place. If you're renting, you sort of know some of the costs, so it's not a huge adjustment. But there are some additional stuff like home insurance and rates that you're not paying currently.
Yeah, and from a wealth building perspective, I think, I like the concept of owning your own home, like having a tax-free asset that you can borrow and leverage against. Which obviously for me, the main thing is around capital growth on the property, and so. Yes, income is great and it helps, but income is taxed. Capital growth is only taxed once you sell it, but the house you live in is not taxed. Okay. Yes, you do need to pay for it in after-tax dollars, but there's always pros and cons to everything. But getting that first home right from a capital growth perspective is important. Okay, from a wealth building perspective. And so what I like to say to people is, yes, first and foremost, don't overstretch yourself. Be very, very cautious of that. But also as well to be mindful that property is also really great for houses that you can, what I call manufacture wealth. If you can renovate it, paint it, put a deck on it, whatever it's going to be, and spruce up the property to make it look better and increase the value, that is also a very interesting thing to kind of take into consideration. I did that personally. When I first bought in my house, it was, old crap home, but in a good area with a nice backyard, good location. We renovated it. We did 2 renovations, funnily enough. I should have probably knocked it, but what you can afford at that point, Anth. Cleaned it up, got it really nice, increased the value substantially by renovating it and making it really nice. Then we could afford it. We went on to the next one. Next part of that stage, we extended the property and increased the value substantially. And I probably couldn't have done that with an apartment. I couldn't have done that with a townhouse. I couldn't have done that with and so, I always lean to houses where I've got the ability to kind of manufacture wealth. But obviously, first and foremost is affordability. Because if you can't buy a house, townhouse might be suitable for you. Yeah. But also be mindful that there's a lot of people with opinions here. So get a trusted team around you that's going to provide you with advice, not just in your lending, not just in your property, but also your holistic side of things as well too.
And I think everyone's different as well. What is the goal? Is it you just want to be able to live in your own place? You want to stop renting because you hate having to move houses every 12 months if that's the case? Or is it something that you want to buy so you can leverage it to get into the position to buy that new property in 5 years' time? So I think everyone's got their own sort of goals and ambitions, and it's just making sure that property lines up with your own goals. Because everyone's going to be different at the end of the day. A couple of other handy tips though with homes and buying homes is some of the costs involved with buying a property that people don't really consider. So conveyancing fees, having a look at a conveyancer to review the contract before you buy, conveyancing costs for settlement. You got to have a look at, you're going to get building and pest inspections, because all this stuff is things you need to pay for. They're not free.
Mate, I'm all over this at the moment.
At settlement, sometimes you need to pay pro rata rates or pro rata water usage and things like that. So keep in mind that, this is what the house is going to cost. This is our stamp duty. This is our loan and our deposit. But just factor in a bit of some extra on top for those extra costs that you may not be aware of.
It's a lot to go through, Anth. A lot of terms, a lot of F, a lot of H's, a lot of O's, and a lot of G's, as you said. But this is really good for people to be aware of stuff. Now, for those that are considering purchasing a property for their first home, or that they might be looking at their kids to purchase a first home, how do they get in touch with you?
Yeah, well, if you reach out to the Thriving Wealth team, jump on our website. We've got our details there. But I would like to actually leave you guys with a couple of tips if you are looking to, or know someone looking to buy your first home. Yeah,
and before you get into these tips, sorry, mate, but I think the biggest thing is what I wanted to get from that exercise, reaching out to Anthony, is that we might not be able to help, but we can sure point you in the right direction. And that's what we want to do for all the viewers and listeners here. Anthony has a wealth of knowledge, just not as, in regards to just first home buyers, obviously coming with his qualifications and what he does, but he has a passion for helping people get into their first home. So when you reach out, don't think that it's like this obligation scenario. He's just there to help and wants to kind of get on here and help out. So thanks for sharing your email. But now over to your tips.
Yeah. So first one is, even give yourself enough lead time, okay? A couple of things you want to know beforehand is how much can we actually afford to borrow and how much of a deposit do we need? If you know this 12 months in advance, you can start building a plan, okay? Let's start saving X amount each month to get to that position. If the loan repayment's going to cost you $4,500 a month and you've got 12 months into it, let's say $4,500 a month, let's say $5,000 a month comfortably to make sure we're able to afford this home. And that's probably going to be our deposit for the home as well. So we're doing 2-in-1 where we're saving the deposit and being able to sort of build in that loan repayment in our lifestyle, which is very, very important. Having a look how much you can borrow. So speaking to a broker, reaching out to me, assessing how much you can borrow based on your income and expenses, having a look at your credit file, making sure there's nothing scary in there that we don't know about. The next one would be, rather than going to a bank directly. So yes, you can always go to a bank directly, but you're limited with that one bank. As I said earlier, each bank has their own policies around different things: first home buyers, self-employed, family guarantors, so many different policies for so many different banks. By speaking to a mortgage broker, we can actually have a look at all the bank's policies. We work with like 20 plus different banks and find which one has the best policy for you. There are some banks, for example, that do 85% LVR for first home buyers and not need to pay any LMI. Or even with not even first home buyers, just owner-occupied properties on themselves, you can actually go 85% with a certain lender and not need to pay any lender's mortgage insurance. And that could be a massive difference for certain people. So making sure you're assessing your options and having a look at different banks and what they will do for you. My other tip is don't get caught up on the rate. Okay, a lot of people are fixated on trying to get the best rate possible, but that's not always what's best for you. Having a look to see what features does it have. Do we have offset accounts, multiple offset accounts? Is it good online banking? Do you have the ability to, when the LVR changes, we can get better pricing on the rate? So the banks offer different pricing discounts for different people and different LVR brackets. So what you see that's advertised, they're not always the rates that you get because the banks do give discounts. So that's another one to keep an eye on. And then the other one would be, don't try overcommit on something to please other people. I think do what suits your situation and your lifestyle and what you need. And it doesn't need to be your forever home, but if that's going to get you to that next stage of life and you're going to be able to live in there for the next 10 plus years and be comfortable, that might help you move to the next property. But don't feel like because you're doing this, you're locked in it forever. Okay. I think people are scared to make that initial jump because it is a massive decision. It's probably the most expensive decision of your life because you're going to be putting a lot of money into a home. But you need to sometimes just take that leap of faith. And if you think you're in the right position and you're ready for it, speak to someone to evaluate your situation and get that professional guidance to know if you're ready or not.
Awesome tips, mate. So hopefully today has been informative for you. And if it has been, make sure you like and subscribe to all of our major music platforms and video platforms that we're on, like YouTube and Spotify and Apple Music and Google Play, because I know you're a Googler or Android man. But thanks for jumping on, and thank you everyone for listening and watching.
Thanks, guys.